Hello YouTube, Herman Williams with ATM Financial Services. Wow, what a week it has been in the stock market. Is the coronavirus hitting your investment hard this week? Does your 401k now look more like a 201k? Well, welcome to the club. The stock market has been extremely volatile this week, and that's putting it mildly. Because this has been such a tough week in the markets, I decided to interrupt our series on retirement planning to use this chaos as a teachable moment. As more and more cases of the coronavirus are reported and more countries are also reporting new cases, economic impact fears have driven the stock market to its worst one-week decline since the financial crisis of 2008. So how can a virus have such a big impact on global markets? Well, this is a not so pleasant reminder of how interconnected the global economy really is. When the outbreak was first spreading in Wuhan, China, that caused some concern for investors for a couple of reasons. One, a lot of companies do business in China, and there were obvious concerns about how the virus might impact business operations in that region. Two, even companies that operate in the U.S. have supply chain risk associated with China. Many goods that are produced in the United States are done so with some parts that come from other countries such as China. As investors have been closely watching the spread of this virus and efforts to contain it, their fears and concerns have been expressed in market volatility. Initially, the volatility was mostly confined to those companies with the most exposure to the China labor force. As more and more people became quarantined, fewer and fewer goods could be produced. As this unfolded, some companies started to revise their earnings forecasts due to uncertainty in that region. At the same time, China was scrambling to try to get the virus under control, at least in their country, and investors kept track of these efforts and also looked to the CDC and the World Health Organization for guidance on how bad this thing might get. When the virus didn't appear to be spreading globally, at least not rapidly, and there was no dire pandemic predictions, investors became cautiously optimistic, hoping that a cure would soon be found, or at a minimum that the virus could be contained. Market volatility subsided just a bit, but with each new report, a quick cure or sustained containment seemed to fade. As that hope faded, it was replaced by even more volatility in the markets. Then things got really bad. Just when it seemed that the number of new cases in China were starting to taper off a bit, the number of new cases in other countries started to increase. This led to more volatility in the market. Then there was a confirmed case in the U.S. that, at least for the moment, doesn't seem to be directly tied to travel to an infected area or exposure to someone who had. Again, more volatility. Then the World Health Organization warned that there could be a global level risk with this virus, and the threat of a pandemic sent an already fragile market tumbling. At about the same time, the Federal Reserve Chair Jerome Powell issued a statement that the Fed would, quote, use our tools to support economy from coronavirus outbreak that poses risk, unquote. I'm sure this was intended to calm the fears of investors, but may have had the opposite effect. By stating that the Fed was ready to take action if needed, seemed to have actually added to the already growing fear that this could get a lot worse before it gets better. So why is a virus like this such a threat to the global economy? Well, in this case, the fear is that the virus could create both a supply and a demand issue. As more and more people are quarantined and unable to do their jobs, fewer goods get produced. This affects the supply side of the economy. If companies can't get their products to market, this affects sales, revenue, profit, and yes, stock prices. When stock prices take a big hit, so does the value of your portfolio. The other thing that potentially happens in a situation like this is that the longer people are prevented from working and traveling, companies could be forced to make decisions on temporarily or permanently shutting down facilities or cutting jobs. When fewer people are working, that means less money is being spent to purchase goods that are available. This affects the demand side of the economy. When fewer goods are bought, revenue, profits, stock prices, and yes, your portfolio value gets hit again. All of these fears combined is what has led to the worst single-week decline in the stock market since the financial crisis. So what do you as an investor and a consumer do about it? Well, you could let panic take over and try to move your investments to cash or other safer alternatives. But if you didn't do that before this week's disastrous slide, it's probably too late for that move. However, every investor situation is different. But if you sell at a time when your portfolio has dropped dramatically, you are essentially locking in those losses and putting yourself in a position where you will be guessing when to buy in again. Remember, until you actually sell, your losses or gains for that matter are only on paper. Now, some economists believe that there will be a V-shaped recovery, meaning that the market will bottom out and then rise again at a similar pace as the decline. That theory depends on a lot of factors though. Things such as how soon will the virus be contained? Will an effective vaccine be developed anytime soon? How much money will companies lose in the meantime? And perhaps most importantly, how long before investors begin to feel confident about the economy again? One thing that may help is that due to some previous trade war fears, a lot of companies have already looked for and shifted their supply chain to be less dependent on China. But if this virus continues to spread, even those new supply channels could be impacted. Something else that savvy investors will do in times like these is look for hitting buying opportunities. When something like this has such a broad impact on the stock market, there are usually stocks that will take a bigger hit than they deserve. Not all companies will have the same exposure or risk to their business fundamentals. The trick is finding those companies that are suddenly undervalued. That's easier said than done, so if you are not experienced at analyzing and valuing stocks, please don't play a guessing game. If you are a long-term investor, meaning you have 10 years or more before you need your funds, chances are you will be okay and your portfolio will recover. After the 2008 financial crisis, the stock market had been on a more than 10-year run and setting new record highs along the way, so there is hope. If you are already retired and need your portfolio to live on, my advice would be to immediately look for ways to curb your spending if possible, at least temporarily. Perhaps delay a major purchase if you can do so. Adjust your spending schedule by postponing vacations, which could also reduce your health risk. You may even need to push the pause button on executing your bucket list. Also, talk to your advisor about possibly reducing your risk exposure as the market recovers. This too is unique to each investor. The other thing that you can do is to continue to watch my videos so that you will be better educated about your finances and be in a better position to make informed decisions. If you are new to investing or considering getting started investing, this may be an opportunity to better construct or better diversify your portfolio. If you don't already have an advisor, please reach out to me and let me help. We will pick up where we left off on our series on retirement planning next week, but I wanted to take this opportunity to talk to you about what has driven the market to such a steep decline this week and give you some things to think about that may help calm your fears just a little, or at a minimum help you understand why this could be but potentially a big deal for all of us. Stay diligent. Continue to arm yourself with knowledge, and until next time, behave well.